Thanks for clicking. Canada's fixed mortgage rates are surging upwards after months of declines, after hotter than expected inflation data has many predicting that the Bank of Canada still has more to do on interest rate hikes. Indeed, following the release of Canada's CPI, Scotiabank became the first major Canadian bank to argue for another rate hike in order for the Bank of Canada to crush inflation. And with prices on the rise, for now, and rates surging upward, questions about affordability are continuing to emerge, especially with the average price of a Canadian home rising by almost $100,000 since January.
But it's going to get worse.
So what I want to do today is go over my best mortgage rates for the month of May, take a look at how affordability has changed since Canada's real estate market stopped its free fall back in January, and then discuss what to look for next in the lead up to the Bank of Canada's rate decision coming out on June 7th. The end of the month is fast approaching, and with that comes the release of May's real estate data coming out from the local boards, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. On to the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you put less than 20% down. You have a 25-year amortization. You qualify at the contract rate plus 2% or 5.25%, whichever is highest, and you pay the mortgage insurance. My best 5-year fixed insured mortgage rate in March was sitting at 4.64%. That dropped down to 4.49 in April, and as of May is now sitting at 4.69, with a 5-year variable rate mortgage sitting at prime minus 1.05, or 5.65%. So after months of continuous declines on the 5-year fixed insured mortgage rate, we're now starting to see it go in the other direction. And insurable mortgage rates are also up this month. Insurable mortgage rates, if you'll remember, that's where you have that 20% down, you have a 25-year amortization, you qualify at the contract rate plus 2% or 5.25%, whichever is highest, and you don't pay the mortgage insurance. 5-year insurable mortgage rates back in March were sitting at 4.89. They dropped down to 4.79 in April, and as of May are sitting at 4.94. And the 5-year variable insurable mortgage rate is sitting at prime minus 0.5, or 6.2%. So we have both the insured and the insurable mortgage rates both popping upwards in the aftermath of the release of Canada's inflation data. And the uninsurable mortgage rates have actually stayed largely the same. Uninsurable mortgage rates, if you remember, that's where you take money out of your home vis-a-vis a refinance or an equity takeout, or you have an amortization up to 30 years. You qualify at the contract rate plus 2% or 5.25%, whichever is highest, and of course you don't pay the mortgage insurance. A 5-year uninsurable mortgage rate in March was sitting at 5.14. That dropped down to 4.94 in April and has stayed largely unchanged at 4.94, with a 5-year variable uninsured mortgage rate sitting at prime minus 0.4 or 6.3%. So we have insured mortgage rates up about 20 basis points, 0.2%, insurable mortgage rates up 15 basis points, 0.15%, and uninsurable mortgage rates staying largely the same. And with real estate prices rising and mortgage rates on their way up, this definitely isn't going to help affordability.
Who gives a flying
So is Canada's real estate market any more affordable right now than it was back in January? If we go back to January, the average price was sitting at $612,000, the benchmark price was sitting at $715,000, and a decent 5-year fixed insured mortgage rate was sitting at 5.69. So borrowers had to qualify at 7.69. If we use that 5.69 rate and qualify at 7.69, back in January, borrowers had to earn $155,000 to get that average priced home with a payment of $3,722, and they had to earn $175,000 to buy the benchmark home with a payment of $4,319. Fast forward to May of 2023, and that average price home has jumped up to $716K, and the benchmark is sitting at $724. And while mortgage rates are still rising right now, sitting at 4.69, they're still much better than they were back in February. Using today's 4.69% and qualifying at 6.69 with minimum down payment requirements, to get that average priced home, borrowers now need to earn $160,000 with a payment of $3,927, and they have to earn $165,000 to get that benchmark price home with a payment of $3,968. So with the average price up up by $100K, but mortgage rates down by about 1%, borrowers have to earn about $5,000 more to get that average price home, and about $10,000 less to get that benchmark price home. So, real estate affordability, while still out of reach of many and definitely worse than it was pre-pandemic, is hovering right around where it was back in January, back when the real estate market stopped its freefall. However, mortgage rates could very well continue their upward trajectory. As we talked about before on this channel in the past, fixed mortgage rates follow bond yields, and Canada's 5-year bond yields are up almost 50 basis points since this point in time last month. And with mortgage rates continuing upward, with bond yields continuing up, and with more and more calls for the Bank of Canada to raise interest rates, I think we're going to see a surge in demand at the end of May's real estate market. I think we're going to see a lot of buyers try to jump into the market before the cost of borrowing goes up, which will create a major upsurge in demand, and as such, we should see prices go back up.
I'm kind of a big deal.
Really?
With that said, it's not clear as of yet that these real estate price increases are sustainable. If we look back to the end of Canada's real estate correction back in January and February, it was due in large part to the Bank of Canada signaling its pause. Even the CREA, the Canadian Real Estate Association, well known for its unbiased assessment of Canada's real estate market, noted at the time that when the Bank of Canada engaged in its pause, it sent the signal to the market that rates had hit their top, that they wouldn't be expecting things to get any worse from here. Now, if the Bank of Canada does reverse on this pause, it reverses on the pause in response to the inflation data, it could very well, maybe even intentionally, send the signal to homebuyers that rates could continue upward from here. The Bank of Canada could very well increase interest rates by 25 basis points in June, and with even the Federal Reserve starting to talk about reversing on its pause, a pause that it just entered into, I don't think it's out of the realm of possibility that the bank would raise rates further if we continue to see more surprises on inflation. So, with interest rates going up, with mortgage rates going up, my guess is we're going to see an increase in activity in May, we're going to see an increase in prices, and we'll obviously have an update out when we get the data on May's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.